Hello and good morning, everyone. Welcome back to Almus Market Mornings, your daily dose of global financial updates. The much awaited US GDP data was out yesterday, and as expected, it was revised higher, but that didn't cause any major movements in the market. Dollar was still marginally weaker, yields continued to tumble, and sentiment remained off market adjusting positions as rate cuts from May 24 get discounted. Moreover, recent data and Fed commentaries has once again sparked the soft landing narrative for the US economy, supporting more rate cuts next year. Good morning, JK. How are you seeing the market after yesterday's data, and what's your expectation?
Good morning, Swaraj. Yes, yesterday's data was, important from the point of view of the growth picture in Eurozone as well as in the US, and also the inflation picture that is, continuing to show a moderation. And the GDP coming at 5.2% beat expectations of 5%, and then, also well above the 2.1% that was recorded in the previous quarter. But as you said, this is a backward-looking data, and people are more keen to see how this quarter is going to, pan out. And if you go by the leading indicators that are available, that does not really show, the growth maintaining this particular level of, economic activity. In fact, if you look at Atlanta Fed's GDP, which is forecasting a sharp slowdown in the current quarter, I mean the October-December quarter, to a 2.1% pace. So that's based on a lot of leading indicators that are emerging. So that one point. As far as the Eurozone is concerned, there were economic sentiment data that got published yesterday, and it was again mixed. Employment was showing slowdown, but the overall economic sentiment was somewhat improved, though it was still in a very low level on a historical basis as well. Now, important point was about the inflation in the Eurozone. Inflation in Eurozone continues to drop, and German inflation, in fact, shows a deflationary trend continuing in October. According to flash estimate, headline inflation came at 3.2% year on year from 3.8% in the previous month. And the main drivers behind falling inflation rates have been favorable base effects across almost all sectors of the economy, as well as actually falling energy prices and price cuts, in several, spendings that government has, imposed. And the only worrisome development was the monthly increase in food prices. In fact, we also had inflation falling in another important economy, that is Spain, where it came well below the expectation. So overall, there is a deflationary trend in the Europe, which can be there for next 1 month or so also. So now going forward, the base effect advantage will vanish, but possibly energy prices will also go up, because we have an important OPEC meeting that is coming up today, where most probably there will be a consensus cut in the output, and that will push up the oil prices once again. And Eurozone economy itself is somewhat looking up, so the demand side can pick up. Possibly we have seen the best of the inflation picture for the very short term. So if you look at the market reactions, bond yields were lower in Asia, they were lower in Europe. Asia followed what happened in US, and then in Europe, it followed the inflation number that came lower than expected. And also now the market seems to have inclination to look at the dovish figures from the Fed, which is actually influencing the numbers. And we had one more member from the US Fed, Mr. Bostic, who was sounding dovish yesterday, and he was saying that the tightening in the financial conditions and the rates have actually had a bigger impact on the economic activity. And as we remember, the previous day also, we had another member who had hinted at the rate cuts being possible if inflation continues to follow for several more months. So on the other hand, market chose to ignore some of the more hawkish statements from other members who were at the mic yesterday. So there is a bias from the market to buy bonds and also to sell the dollar. But while the bond yields made a new low, particularly in 10-year, which went to 4.25%, and also on the 2-year that came close to 4.6%. Dollar did not make a new low yesterday after the initial push down in the Asian market, and that was more of a thin market. We saw euro being pushed down towards 1.0960 from a high of 1.1015, and also the the yen, which found support below 146 as well. And that I can say two reasons: one, short-term overbought conditions, and also these currencies being up against a very strong resistance. We head into an FOMC unemployment data next week, and one more inflation number next month. All of this, and then head into the Christmas period. So I think market may be more in a mood to consolidate the gains of the currencies as well as the bond prices. This can be leading into a period more of consolidation. Maybe a few more moves on the upside can be attempted, but I think that will be well resisted, and we may be well into a period of profit taking as far as the markets are concerned. Just remember that the dollar index has moved close to 4% in the last 2 months, and that is quite a lot of movement. And November has seen the highest movement for a month after almost similar move in in 2022 as well. Looking ahead, we have the PCE core inflation tonight, where almost all the components look lower than the previous month, and then we also have the Eurozone inflation, which again, you should expect it to be lower than expected because the individual countries themselves have shown lower inflation number. Now, come to India, we did not have, as expected, much of a reaction to the big dollar fall or the dollar yields that fell yesterday. And we, the rupee made a slight gain towards 83.28, but the bounce back was very prompt, and we traded as high as 82.35 in the day trades. Once again, the influential demand was back in the market with supplies somewhat mixed this time. We had some foreign banks selling. We also had the state-run banks selling. So that took care of the demand for the most part. But now market is looking forward to two important events. That is, one is the GDP number of India, which is going to be published today. The expectation is for around 7.1%, and that's going to be lower than the 7.8% of the previous quarter, and quite expected. But overall, the higher consumption, as indicated by several fast-moving indicators, as well as the government's investment, continued increase in the government investments in infra, etc., will ensure that growth for the full year is on track. 6.5% is what is forecast by RBI, and that will be, I think, achievable. While we say it's a backward-looking data, when we talk about the US data, in India, market will be interested and may react to the GDP data because we do not have as many leading indicators published as frequently as in the developed countries. And so therefore, GDP data always holds some surprise, and market does look forward to it with a lot of interest. And the other event that we are looking forward to is the political event of exit polls, as the last phase of the election happens to the Telangana state today. Exit polls nowadays almost matches the final results. Therefore, market will be keen to look at how the outcome is any large deviations, in favor of either of the parties can be a market swinger. So any reaction will be seen tomorrow, both in terms of stocks, bonds, and currency as well. But overall, looking at the technical picture, rupee does not show signs that there is any imminent breakout on either side, and we need really some large flows, either outflow or inflow, to push it in a big way, and the central bank, of course, to keep its hands off to allow such a moment to happen. In the global scenario, also we have the important OPEC meeting. There have been differences among various members about the level of output cut that they need to adhere to, and if they iron out the differences and can come to a consensus, what comes out today can be a big mover for the oil prices, and that will have an impact on the inflation picture going forward. Thank you.
Thank you, JK. And you very interestingly said for any move to happen in rupee, the central bank will need to keep its hands off. As JK mentioned, quickly summarizing, for rupee, there was no reaction to the dollar fall, slight gain towards 83.28, but then demand from there emerged. Indian GDP data to be published today, and that's something markets would be looking forward to. And of course, the exit polls results, which will be out soon. On the US front, we have the PCE core inflation tonight, but all components look lower. Even we have got Eurozone inflation data. Again, all components look lower, given by going by how other countries have displayed, other European countries have put out their inflation numbers. German inflation data, which came out yesterday, shows a deflationary trend because of favorable base effects as well as falling energy prices. And of course, when it comes to US, the US GDP came at 5.2% for Q3 against expected 5%. But more focus would be on the current quarter's performance, as leading indicators have been on the weaker side for the US. And interestingly, Atlanta Fed's GDP leading indicator is showing a sharp slowdown this quarter. So we'll keep following this story and do tune in tomorrow for the latest in the financial markets. Thanks for listening.